Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 347 of the Independent Advisors Podcast. On today's show, we're covering a few important and timely topics, including words of advice from one of the most successful investment money managers of our time, why the first 15 days of April are so important for the stock market, and some new data about stock buybacks in corporate America here. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. Let's jump in. So before we begin with big headlines and current events, I will start with pricing as we normally do. As always, we review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from YCharts and is as of the market close on April 21st, 2026. S&P 500 index year-to-date up 3.19%. Month-to-date up 8.20%. Dow Jones Industrial Average year-to-date up 2.26%. Month-to-date up 6.06%. NASDAQ Composite year-to-date up 4.38%. Month-to-date up 12.36%. The IWM Small Cap ETF year-to-date up 11.72%. Month-to-date up 10.69%. The Vanguard All World ex-United States ETF year-to-date up 8.54%, month-to-date up 6.15%. Taking a look at the bond market, yields, 3-month yield on treasuries this morning ticking, and the time on that is April 22nd, right around 9 a.m., 3.68%. 2-year at 3.78% yield, and the 10-year sits at 4.28%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Big headlines and current events, listeners and viewers, I would argue the main focus is earnings season. Yes, we continue to have the geopolitical headlines predominantly in the Middle East, but I would argue a lot of the stock market's focus over the past week has definitely been the beginning of Q1 earnings season. When we begin that earnings season, which tends to be around the 15th or so of the month, so far, the early reporters are typically financial and healthcare-oriented firms. Those earnings so far have been good, and the market has been reacting appropriately. We get the bulk of earnings for Q1 happening the week of April 27th. That's where a bulk of S&P 500 companies are going to be reporting those earnings, and there will be definitely a lot of eyes on those names. Word of wisdom: if you're seeing a larger movement up or down in a specific stock over the next couple of weeks, and it kind of seems outsized either way, there's a good chance it's because they reported earnings and the market is reacting to that new data. As a polite reminder to some of our newer listeners, we got to remember that these publicly traded companies report their earnings to shareholders every quarter. And when they report those earnings, they release a lot of data that the market didn't have previously for several months, which is why those moves tend to be a little bit bigger when they report. Moving on, tweets, articles, and research from this week. Mark was unable to be on the podcast this week. I'm going to discuss a couple of topics that caught his eye over the past week. And the first thing that caught Mark's eye was an interview of a legendary money manager, and his name is Stan Druckenmiller. He gave an interview. Stan Druckenmiller, chairman and CEO of the Duquesne Family Office, one of the most famous money managers of our time, was recently interviewed by Bloomberg. He told a story where he shorted $200 million worth of internet stocks in March of 1999. In 3 weeks, he closed out his short positions for a $600 million loss. Quote, I was short 12 stocks. They all ended up going bankrupt, every one of them. If you're dead wrong on a long, meaning you own a stock for its appreciation, you can only lose 100%. If you're dead wrong on a short, you can lose 10 times your money, end quote. So what's the moral of the story? Even if your investment thesis is correct, it's hard to time exactly when the thesis will play out, even for some of the best money managers in the world. That was Mark's comments, and it makes sense. And we got to realize for some of our newer listeners, the term shorting is where people will borrow shares and bet that they will go down in value so they can buy them back at a lower price. It's dangerous, and you got to be careful because you can end up losing more than 100% of your original investment, as this story indicates. Good piece there by Mark. Next one Mark highlighted is an ex-post from Matt Ceramitero, who we've had on the podcast before. This was an ex-post by Matt, and the timestamp on this was April 15th. Matt had a piece, and it goes like this. Since 1928, when the S&P 500 is up more than 5% in the first 15 days of April, the market is up on average. I almost don't want to say this out loud. 31.9% the rest of the year. Currently, at the time Matt posted this, April 15th, at that point, the S&P was up 7.6% in 2026. First half of April matters is what Matt said. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. For newer listeners, our show notes are going to be in all of our major social media sites for Jessup Wealth Management. It's going to be the likes of Facebook, LinkedIn, X, etc. Interesting piece. These stats are important. They're a good data point. I wouldn't be making overall, final investment decisions on them. I think they're good data points to have in consideration. The third thing Mark had is a chart from Ryan Dietrich from Carson Investment Research. The timestamp on this is April 10th. The title of this chart that caught Mark's eye is, quote, more clues the lows are in. What this chart is indicating, and Jenna will put this up for our YouTube viewers, this of course will be in our show notes as well on all of our social media sites, is S&P 500 performance after back-to-back 3% plus weekly gains in the stock market. And the data set goes back to 1950. And what Ryan's posting here, and it's roughly about 15 or so data points, maybe a couple more than that. You're looking at the average returns looking forward after the market makes those back-to-back 3% plus moves back-to-back weeks. 3 months later, on average, the stock market is higher by 5.8% and higher 81% of the time of the data sets when this has happened historically. 6 months later, on average, up 9.8%, higher 81.3% of the time again. And 12 months later, on average, up 14.1%, higher 86.7% of the time. Makes sense why Mark picked these items this week. I think it's important to get perspective, especially when the market is volatile. I know I made some comments on the podcast a week ago. My thoughts on the market, those thoughts have not changed. And if you're curious as to the details of my thoughts Looking out the rest of the year, episode 346 of the Independent Advisors podcast was an absolute banger. It was a great one, and I would encourage you to take a peek at that, listen to it, watch it if you haven't already.
We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Now we're going to transition to my items that I had selected for this week before I go over a financial planning topic of the week. I'm going to start off with the topic of stock buybacks. I've talked about this on the podcast pretty regularly over the last several years. Let's start with some education on the topic. Stock buybacks is a very popular way for corporate America to return cash to shareholders. What they do is with excess profits, they will go out on the open market, buy shares of their own company, and retire them, tear them up, get rid of them. It makes the remaining shares available artificially worth more. Companies do this, again, to return capital and reward shareholders. I saw a piece from the Kobayashi letter, timestamp April 20th. This is what they said. Massive buybacks are coming to the U.S. market. Buyback authorizations across the Russell 3000 surged 36% year over year to a record $428 billion so far here in 2026. Authorizations are now 176% above the same period in 2020. At a historical execution rate of 90%, U.S. corporates are now on track to repurchase a record $1 trillion in shares this year. In 2 weeks, the corporate buyback window will reopen following the earnings blackout period. What they're meaning there, and I'm ending my quote for a second, and it's important to note, companies cannot be buying back their own shares within 2 weeks of their earnings results that they will announce. This will bring an additional wave of demand for stocks at a time when the market is already experiencing a historical run, the Kobayashi letter said. U.S. corporations are set to be major buyers in the equity markets. There is an illustration that was on the X post for the Kobayashi letter. Unfortunately, when you zoom in, it's very fuzzy, and it shows the historical buyback authorizations through April 14th of each year, going back about roughly 20 years. It's very quick to see that we're kind of off the charts and definitely at a high point in relative to history. So why did I pick this? We got to be careful in the stock market to think that some of these doom and gloom headlines are certain. Could some of these scenarios make their way to fruition? Absolutely. But we got to realize right now, corporate America is flush with cash and very profitable. And a lot of these C-suites in corporate America have their incentivization compensation packages very stock heavy. You have a C-suite at a lot of these companies that are highly motivated and focused on their stock's performance. As an investor in companies like that, I like that. I want the C-suite motivated on that stock price. And guess what? Stock buybacks is a way to fuel that for shareholders. I like it. I like to focus on companies that are buying back their own stock. I think it's very bullish. Let's transition and let's talk about a financial planning topic of the week. Since I'm solo here on the podcast, it'll be a little more abbreviated this week. But what I did is I came up with what I would call a 5-minute mid-year financial checkup. It's April. We're already one third halfway through the year. Question is how's your financial plan holding up? Life moves fast. Markets shift. Priorities can change without us even noticing. So today I'm going to give you a simple 5-minute mid-year checkup that you can do this week. It takes almost no time, but can save you money and stress before the year flies by. So what's first? Step 1. Let's revisit goals. Pull out whatever you set at the beginning of the year. Was it paying down debt? Building an emergency fund? Saving for a vacation? Ramping up for retirement? Ask yourself, have my priorities shifted? Am I on track, ahead, falling behind? Write down 1 or 2 goals and the exact dollar amount or percentage you want to hit by December 31st, 2026. Clarity here is everything. Step 2, second, check your budget and cash flow. Look at the last 3 months of spending. Are you still sticking to your targets? Or has lifestyle creep snuck in? Compare income versus expenses. Quick win. If you're spending more than planned, find one category to trim. Subscriptions, dining out, impulse purchases. If you're coming in under budget, redirect that extra money straight into savings or debt. Step 3, third, review your emergency fund in debt. A good rule of thumb is to aim for 3 to 6 months of essential expenses in safe liquid account. Has anything drained it lately? Top it back off if needed. On the debt side, focus on high interest credit cards first. Even a small extra payment now compounds in your favor. Step 4, look at retirement and tax advantage accounts. For 2026, you can contribute up to $24,500 into a 401k, plus an $8,000 catch-up if you're 50 or older. IRAs, $7,500, plus an $1,100 catch-up if you're over 50. HSAs, $4,400 for self-only, $8,750 for a family, plus another $1,000 for catch-up if you're 55 or older. Calculate how much you contributed so far this year, see what's left. If you're behind in the match or max, increase your payroll deduction today. Even 1% can make a big difference. Step 5, finally, glance at your investments and protection. Is your portfolio still aligned with your risk tolerance, or has the market moved it out of balance? A quick rebalance might be in order. Also check that your insurance, that's things like life, disability, and health, and beneficiaries are up to date, especially after any family or job changes. So what's the takeaway? There's 5 quick areas that you can keep within your control. Doing this now gives you a full 6 months to course correct instead of scrambling in the 4th quarter of this year. If any of these steps feel overwhelming, or you want a second set of eyes on your specific numbers, I want to encourage you to reach out to the team. We'll sit down for a no pressure review and help you turn around your mid-year checkup into real progress. You can go right to the Jessup Wealth Management website. You can click on setting up a 15-minute phone appointment with myself, the CEO of the firm. And I could always help you through these items. And I can also direct you to Taylor Ledbetter. She's head of financial planning for Jessup Wealth Management. She's a frequent guest and speaker here on the Independent Advisors podcast. She's phenomenal and has a lot of intellect. She's a CFP, certified financial planner, and I can always get you in touch with her as well. So I will sign off for this week. Thank you for listening to episode 347 of the Independent Advisors Podcast. Look forward to catching you next week for episode 348. Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.